So a big part of personal finance is deciding how to allocate your income strategically for your necessities. In our lives, we make these major decisions and purchases, and if you want to achieve financial freedom, we want to be careful of these financial traps that can delay or prevent wealth building altogether. So in today's video, I want to talk about the 3 biggest financial traps that people get into that you should be cognizant of when it comes to money management and allocating your budget. Welcome if you've never seen me before. My name is Alice. I'm a CPA. I make videos on personal finance and business on this channel. Make sure you join my newsletter and consider subscribing to the channel if you find my videos helpful. The first financial trap is spending more than 30% of what you make on housing. So according to this article that was released by the US Census, the data shows that the median income to housing ratio is 30% for renters, which has been consistent between 2022 to 2024, or the last 3 years. But at the same time, that is just the median, not the average. And over 21 million renter households spent more than 30% of their income on housing costs. When a household spends more than 30% of what they make on housing, then the likelihood of living paycheck to paycheck increases, because the data also shows that 70% of Americans require a car for work. So if you need a car for work and you're either leasing or financing a vehicle, and you need to spend more than 30% of your income on housing, that immediately puts your cash flow in a pinch. That's before eating, before having kids, before having lifestyle or any entertainment, or paying off your debts. So the general recommendation is that if your income is $5,000 a month after tax, the advice is not to spend more than $1,500 a month on housing if you can, especially. So if you are making $5,000 a month after tax, the advice is not to spend more than $1,500 a month on housing. The reason why housing costs have gone up so much in the past 10 years in proportion to wages is because of supply and demand. You might be wondering, well, what about homeowners? The same data reported by the US Census shows that this number is around 21% for homeowners with a mortgage and 11.5% without a mortgage. The data is actually less consistent for homeowners if we take a look at a few different sources, because there's a wide range of factors. When the house was purchased, what the remaining amount left is on the loan. Other studies that have been published say that this can be up to 30% for homeowners with a mortgage. The industry standards in the US for approving mortgages suggest that your total debt shouldn't be more than 36% of your income, and your monthly mortgage payment should be about 28% of your gross monthly income. So on the same example, on a $5,000 after-tax household income, that's spending no more than $1,400 on your monthly mortgage payment. When it comes to purchasing a home or renting, always take into account your long-term financial plans and your cash flow planning, and think twice about borrowing to the maximum limit that the bank will allow you to have, and think about these ratios, the 30% ratio in particular, in mind. Preventing yourself from being cash strapped to a mortgage or to a rent payment will really help alleviate any stress around monthly cash flows. The second financial trap to avoid is spending more than 10 to 20% of your income on a car. Now, cars, in addition to houses, are one of the biggest financial decisions that people will make in their lifetime. And many people get trapped at the dealership into long contracts, or they make bad purchasing decisions. Now, according to the US Department of Transportation, the data shows that higher income households tend to spend around 10% on vehicles, whereas lower income households can spend 20% or more. And the US Department of Transportation also estimates that it costs around 81 cents per mile to operate and maintain a new vehicle. The reason why cars are a big financial trap than houses is because people are prone to poor decisions when it comes to purchasing vehicles. One bad decision that I can give you, for example, is financing a Tesla over 84 months at a 5% interest rate. So going back to the $5,000 a month example, if that person can spend $1,500 on their rent or their mortgage and no more than $1,000, which is 20%, on a vehicle, that still gives that person or that household $2,500, which is quite a bit for food, entertainment, and savings. So it's a very easy lifestyle trap that people can fall into when it comes to leasing vehicles, because nobody really wants to downgrade their car. There are also a lot of hidden costs of car ownership, insurance, depreciation, fuel, that aren't always taken into consideration when people enter into car contracts. The financial trap that people fall into when they enter into a new car purchase is thinking that the car is an asset to them because it has resale value, or entering into a lease contract thinking that they got a good deal because the monthly payments quoted were less than finance payment. Vehicles, they provide a lot of psychological gratification to people, but between spending more than 30% on housing and more than 10 to 20% of your income on a vehicle, 20% at the very high end, you start to fall into this trap of living beyond your means. And when you live beyond your means, it makes it very difficult to save, to invest, and to build wealth for your future endeavors. Third financial trap is financing consumer purchases. So America is a debt-based society. Colleges are very expensive and people get into a ton of student debt before they even start life as an adult, let alone the cost of housing, living expenses, and real estate on top of that. Now, debt can be a tricky subject because there's this gray area on what's considered good debt and what's considered bad debt. So long as you understand the difference between what an asset is and a liability is, you can avoid this money trap of using debt to buy liabilities. The general rule of thumb is that if you have to purchase something on credit, think twice about whether you can really afford it. Now, the wealthier you are, the more likely you will carry debt. But of course, if you earn more, the easier it is to pay off that debt. And on the other hand, the lower your income is, the more of your income is going to go towards paying debt. Here's an interesting statistic on credit card debt up on screen here. Now, these percentiles are based on income. So in the 90 to 100% group here, people that are earning more than $500,000 a year are in this group, and they're spending around 4% of their income on debt. So the data shows that the more money that people make, the more debt, total debt, they're likely to carry, but they also spend less of their income paying it off. Another form of bad debt are payday loans, cash advances on credit cards. These can be a really steep trap for people, borrowing money in advance of your payday or incurring debt at a 20% plus interest rate. Now, we're all taught that debt is bad, but there are some positive use cases for debt if it's used to earn money, and many people do use debt to increase their wealth. The caveat is that it has to be used responsibly. A lot of companies will use debt to grow and scale their businesses. Now, there is risk associated with that, of course, and typically it's a CFO that makes the final call or the decision on how much debt a company should take on relative to equity. So if you need to finance something on credit, one good question that you can ask yourself before making that decision is there going to be a potential return on what I'm purchasing? Is there going to be an ROI on what it is that you are spending the credit on? And if you're not sure, you can check with your accountant or do some research to see whether you can expense the interest for tax purposes. I'm not against credit cards at all. I use credit cards myself. You are the product when it comes to using credit cards. Credit card companies, they will front you the cash basically for a month, give you the rewards, maybe even give you some bonuses to spend in the first months because they make more from you in swipe fees, which aren't a direct cost to you, interest and late payment fees, than they do gifting you the rewards and the convenience. So as long as you don't change your spending habits because you're using a credit card, then I would say go for it and use them responsibly. There's no reason not to use credit cards or avoid credit cards as long as you're disciplined enough to pay off your credit card balances entirely every month. Treat your credit cards as if they are debit cards, as if you paid with cash, and take the amount of your budget accordingly and immediately. Don't wait for the credit card bill to come or let the credit card bill pile up. If you like this video today, you're going to love my other video on whether you should lease, finance, or buy a car. In that video, I actually take you directly to the dealership and I compare the 3 different options, talk about all the pros and cons of each, as well as the differences between regular cars versus luxury cars, and just some things to consider if you are in the market for purchasing a new vehicle and you want to make a good financial decision for yourself. So make sure you check out that video up top. Let me know down in the comments below what your experience is with these 3 financial traps that I've mentioned today, and I'll see you guys in the next video. Until next time.